All right. Today is Sunday, January 9th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, but before we start, just a message here, because it appears that YouTube is not liking what we're doing here. This channel is getting hit, be it by limited ads, be it by unfavorable algorithms, be it by hours and hours spent in checking every single video before getting approved for ads and release. And therefore, if you want to support this channel, you don't have to watch entire ads. All what you have to do is click on the link, whatever ad they give you, they show you, click on the link. Once the link opens, close the link, skip the ad, and you're back in business. And this will improve the RPM for this channel. And if enough of you do that, the channel will become too hot to suppress and ignore. Anyhow, let's move on to the main subject of the day, and here it is. In focus tonight, the icy hot jobs report that we got on Friday. You see, the cooks at the Bureau of Labor Statistics, they wanted to give us a cold number, a cold reading. Why would they do that, by the way? The reason is to manipulate the stock market higher, because bad economic news are good news for the stock market. And this phenomenon is due to the Federal Reserve's manipulation of the stock market and the economy. You see, if we have bad news on the economic front, specifically in jobs, that will persuade the Federal Reserve to become more lenient in their hawkish policy of pulling away support and quote-unquote accommodation from the stock market. A bad job number could mean that the Federal Reserve will be more patient. They're not going to raise interest rates abruptly. They're going to push that down the road. Perhaps they're not going to unwind the balance sheet as quickly as they signaled before. And you and I know that this market, the only reason that this stock market blasted higher for years and years and years, but specifically during the pandemic, is due to the Fed's largesse by issuing the tsunami of liquidity. Without that tsunami of liquidity and generosity from the Fed, the stock market will fall apart because there are no fundamentals supporting these high valuations. And therefore, the cooks in the morning from the Bureau of Labor Statistics wanted to give us a cold reading, because the Bureau, believe it or not, has lost all credibility. All what they do is manipulate the data to please Wall Street or whatever government in charge. Now, before the number was released, the expectations were for 433,000 jobs created in December. And here it is. Drum roll, please. And the headline reads, U.S. employers added fewer jobs in December than forecast, while the jobless rate fell.
Icy hot.
The number the cooks gave us is 199,000 jobs, not 200,000 jobs. 199,000 jobs precisely. The problem is, they also gave us a reading of 3.9% for the unemployment rate. And hence, once again,
Icy hot.
You see, the cooks, they can manipulate the headline reading, but the devil is always in the details. They gave us a cold reading, which is comical, by the way. And the Bureau of Labor Statistics has lost all credibility right now. I trust the numbers from the CCP than the Bureau of Labor Statistics, the most manipulated numbers and pieces of data on earth. Because if you recall, earlier that week, we got the ADP jobs report, which only reflects jobs in the private sector of the economy. And that jobs report, the ADP, was absolutely hot. Over 800,000 jobs were created in the private sector alone in December. 246,000 jobs in leisure and hospitality alone. But the cooks at the Bureau of Labor Statistics say if you combine the public and the private sector, you only get 199,000 jobs. What a joke. And they say that the entire economy only created about 55,000 jobs in leisure and hospitality. So once again, who's lying here? Is it the ADP report, the private company, or is it the cooks at the Bureau of Labor Statistics? I think the answer is clear. But what the cooks forgot, or perhaps unable to cook, is the unemployment rate and wage inflation, and therefore the icy hot phenomenon.
Icy hot.
The icy is the 199,000 jobs created in December. The hot is the unemployment rate, which fell below 4% in December. On top of that, the change in average hourly earnings shot up higher, and it is the highest advance since April of last year. But don't get too excited here, because the Fed has been beating the drum. We are not going to remove the accommodation from underneath Wall Street and the rich and the stock market until we get quote-unquote maximum employment. And you and I know that this is a bullshit goal It will never happen because there is no such thing as maximum employment. Matter of fact, the Fed did not even define what maximum employment is. And in the last Fed conference, when Jerome Powell was taking questions from reporters, they asked this question over and over and over again. What do you mean by maximum employment? What do you mean by maximum employment? And Powell weaseled his way around not to answer this question. And now Mr. Powell is facing the worst case scenario. He is facing a red-hot inflation. But he said, you know what? You got to be a little patient with inflation. At first he said it's transitory. Now he says it's not transitory. But you got to be patient because we're going to get maximum employment. Well, guess what? We're not getting maximum employment. If this number is true, 199,000 jobs, way below expectations, and that proves one or two things. Either the Fed's policy is failing in recovering all of the jobs that we lost pre-pandemic, or that the Fed policy has nothing to do with recovering all of these jobs. And we have other exogenous factors. For example, retirement, estate planning, the young generation making money from Twitch, social media, OnlyFans, farting in a jar, and therefore whatever the Fed does, they're never going to recover all of the jobs that we lost pre-pandemic. Not going to happen. And all what they do by keeping the so-called accommodative policy to Wall Street and the stock market is higher inflation, but not a lot of tangible gains in the jobs front. And before you get too excited, by the way, about your wages going higher, your wages went higher by about 4.7% year over year. Now, the CPI inflation, which is the cooked version of inflation, the manipulated piece of data, says that inflation is over 6% year over year. So even with the advance in wages, you're still losing money. And by the way, if they calculate inflation correctly by including housing and rent prices, inflation would read 15% by certain estimates. So again, your wages went higher by 4.7%, yet the true CPI is at almost 15%. So all in all, you're losing money. You're down. You're down over 10%. Your purchasing power is down. Your quality of life is down because you're paying a lot more in rent than the bump that you got in your wages. Regardless, what are the implications of the icy hot jobs report on the Fed's policy? I say this is the worst case scenario for Powell because it proves that his policy either number one, not effective in the jobs front, or has absolutely no relationship whatsoever in creating jobs or recovering jobs. On the other hand, it is yet another proof that Powell's policies are pushing inflation higher and higher and higher because, believe it or not, the gain in wage inflation will be reflected in higher prices for us, the consumer. And we cannot celebrate wage gains when they're lagging inflation. So this is the worst case scenario for Powell and for the stock market, by the way. And here's a tweet from Bloomberg's Lisa Bromowitz, and she says, correctly by the way, this is the best take I've heard so far. She says, big miss on the headline jobs number. This is the icy part of the report. But this is a complicated report, and I'd argue it gives the Fed more ammunition to be hawkish. Here comes the hot part. Wages increased more than expected. The jobless rate fell to the lowest since February of 2020, and the participation rate was unchanged from November. So if you had any hopes the Fed is bluffing, they're never going to raise interest rates because Jerome Powell cares about your portfolio, think again. If anything, perhaps the Fed, Clarida and the rest of the criminals, perhaps they're shorting the market right now. They already dumped. We know they sold at the top. Perhaps they're now shorting the market. And this is not going to get any better, folks. Inflation is going to continue to skyrocket without aggressive policy change by the Fed. The aggressive policy change by the Fed will induce a market crash and perhaps a recession, because this is the perfect storm for inflation. It's not just the Fed's incompetent policy, but you combine this with the virus and the weather phenomenon, and you have the perfect inflation storm, the likes that we've never seen before. Not even in the 1970s. And if you leave this inflation unchecked, it will make the 1970s inflation look like a little baby. And the worst part of this inflation, by the way, is food inflation, because it hurts families, specifically poor and middle-class families, the most, and it will cause a famine crisis globally. There are a lot of countries, by the way, who don't have the luxury or the sufficiency of producing their own food. They have to import the food, and prices are surging out of whack. We're going to see a massive hunger crisis across the globe. The headline reads, the Pokemon spread means more food outages at U.S. grocery stores. And have you noticed how high oil prices have gone? We're not talking about crude oil prices, by the way. We're talking about cooking oil. The highest ever, vegetable oil prices risk even faster inflation. Look at the chart of canola oil prices. One of the most insane charts I've seen in any commodity. Sky high. And it's not just canola prices, by the way. Vegetable oil prices across the board. These prices are surging out of whack. Now ask yourself a question. Is this inflationary or disinflationary? I think the answer is clear. Another one. When we talk about food inflation, soybeans are one of the most important components. Matter of fact, soybeans are the core of the food pyramid because we use soybeans for cattle feed, for chicken feed. All of the meats that we produce, soybeans compose the feed that we rely on in producing all of these meats. You see, the administration is bitching and whining about meat prices surging out of whack, and their solution is price controls. Absolutely delusional, because even if you spend billions of dollars to encourage more competition in the meat industry, they're still going to pay higher prices for soybeans. And we have weather phenomena like La Nina, which is impacting the production in one of the largest producers of soybeans, Brazil. Their production is being halted right now due to the phenomenon of La Nina. So we have the Fed's reckless policy pushing soybean commodities aggressively higher. And then on top of that, we have the weather phenomenon, which is impacting supply. You combine both together, and you have an enormous wave of inflation, specifically food inflation. We haven't seen anything yet. And these weather phenomenons, by the way, becoming more and more frequent. We look at the weather-related insured losses, you can see the trend. We had exceptions and outliers before, but you cannot ignore this trend. It is clearly moving to the upside. And by the way, as these phenomenons, be it La Nina, be it tornadoes, be it drought, be it excessive heat or excessive cold, it doesn't matter to me. As these phenomenons and occurrences become more frequent, we're going to need more insurance against these weather-related phenomenons. What does that mean? Insurance cost is yet another input costs for farmers and producers. Guess what insurance companies are doing right now? They're jacking up those prices higher and higher and higher. So the farmers, the producers are going to pay more in input cost. That will be reflected on higher prices for us, the end consumers. Once again, if you thought inflation is transitory or inflation is just here to stay for a little while, think again. This is the perfect storm of inflation. And let's talk about potatoes, by the way, because potatoes are one of the cheapest food items left. Every other item went higher in the latest CPI, with the exception of potatoes. So if you thought, hey, let them eat potatoes, that's not going to work either. Because yes, prices went down, but believe it or not, we still have a shortage in potatoes. Perhaps prices went down because there is no supply. A growing global potato shortage is affecting French fries from Japan to Kenya. Now they're coming after your French fries too. And by the way, yesterday I cooked filet mignon with mashed potatoes and salad. We only cook filet mignon, by the way, when we have good trading weeks. Otherwise, we stick to tuna cans. But anyways, with all the advancement in technology, with the metaverse, EVs, going to space, farts in a jar, we cannot figure out how to peel potatoes automatically. Every time I peel potatoes, it's a bloodbath in the kitchen. I cut 2 fingers yesterday. Honey, would you like some mashed potatoes with a side of blood?
Can I get 8 from eating this?
And I know what you're going to say. What about that automatic potato peeler on Amazon? Get yourself one of those. You mean the potato peeler with the fake reviews? That's not going to work. You know why? Because potatoes come in all shapes and sizes. I'd like to see Elon Musk or some of these geniuses inventing an automatic potato peeler where it scans the potato in microseconds and it figures out how to peel it right away. That is an advancement in technology, not the stupid metaverse. But if you think about it, there are no shortages in the metaverse. You can make your own potatoes. You can make your own meat and beef. So if you want to channel your inner Marie Antoinette, just say, let them live in the metaverse. Because real life is a luxury. It's only for the rich. But here it is again. Inflation is not stopping, folks. Lumber. Remember the transitory lumber? Well, lumber is soaring again, thanks to supply snags from Canadian floods. Again, combine the reckless policy from the Fed with the weather phenomenon, with the virus, and the lockdowns, and the shortages, and the ports. You got the perfect storm for this inflation to go way out of whack. Here's the headline once again. The Thing. 19 cases among dock workers are colliding with the pandemic-fueled surge in cargo volumes. This is not going to stop. And who knows what other variants are going to release next. This is not going to stop, folks. The Fed is way behind the curve. They need to act immediately. And by acting immediately, the stock market is going to crash. What about gasoline prices? The manipulation, the release from the Strategic Petroleum Reserve, and the Pokemon and all the aggressive policies of locking down and restrictions for what it appears to be, for now at least, a very mild disease. But perhaps they're doing all of this to tame inflation. Because God forbid, if central banks have to tackle this inflation by raising interest rates higher, that's going to blow up a lot of zombie companies and a lot of zombie economies, including the United States of America, which is drowned in debt, by the way. You hike these interest rates higher and inflation doesn't stop, and you go aggressively, you're going to blow up the entire global economy. Unfortunately, though, the Pokemon is actually producing more inflation because it's a snag on supply. It might dent demand for a little while, but it's also pushing supply down because workers have to stay at home when they get infected. Ships are not moving, goods are not moving, factories are stopping, etc., etc. And here it is. Gasoline prices popping higher again. Despite all the manipulation, despite the Pokemon, they're moving higher again. What did I tell you before? Inflation is always a monetary phenomenon. It doesn't matter what they do. From the fiscal policy side, from the manipulation side, from cooking the data side, that doesn't matter. Inflation will continue to surge out of whack until the Fed becomes aggressive in their interest hike policies. And look at gas prices. They peaked. Now they're moving higher again. So all what they've done here, they might give us a colder CPI reading, and they're going to celebrate on CNBC and the news media. They're going to have the biggest orgy you've ever seen. And that will be done by design, by the way, because the engineering of inflation expectations is extremely important. So we get a CPI for December that is down month over month, and the reason is energy prices and gasoline prices in specific went down. CNBC will beat the drum all day long. Matter of fact, the evening news, CBC, NBC, ABC, Fox, all of them, CNN, they're going to say, oh, the inflation reading is down month over month. Inflation is peaking. And this is all done by design to engineer your perspective, most importantly, your expectations, that inflation is indeed peaking and I should wait in spending until prices go down. Here's the problem. Prices are not going to go down. If there is anything that is transitory, it will be the dip in inflation because as you can see, gasoline prices are moving higher again. Commodity prices, specifically crude oil prices, be it the WTI or Brent, they've all almost recovered the entire drop from the Pokemon. Take, for example, crude oil Brent prices. They're now trading above 80 again. Matter of fact, Goldman Sachs says that the super cycle in commodities could last a decade. The super cycle is in commodities. Not as Dan Ives, the thupathakal guy, right? It's not happening in Apple and Tesla. It is happening in commodities. On top of that, we have a worker shortage. The labor shortage is contributing to higher prices and higher wages. There are many factors behind the labor shortage and the lack of labor participation in this economy. One of them is retirement. Another one is estate planning, where the older generation passed a lot of money, a lot of wealth down to Gen Xers, millennials, etc. And a lot of them are using this money to stay at home. Property values skyrocketed, and therefore you have a lot of households who took home equity loans and they started new businesses and perhaps used this money to invest in the stock market or create other avenues to earn an income here beside working. We also have a lot of college graduates who did not graduate, and the reason is the lockdowns, the pandemic, the restrictions, and therefore they delayed their studies. So the job market is missing a lot of graduates here. On top of that, the new generation of employees, the Gen Zers and millennials, specifically the younger ones, they're earning income from social media, from Twitch, from Roblox, from NFTs, from OnlyFans, from Instagram, from farting in a jar, and therefore we have less participation from that particular group. Another element is the lack of immigration. Since the pandemic started, we're not issuing more visas to immigrants. For temporary workers, for example. If you have a fast food establishment, for example, you're looking for low-skilled workers. You used to hire teenagers. Well, now they're not available. They're not working anymore. A lot of them are making income by other means. A lot of them are staying at home with their parents. They're not paying rent. It's an emergency, and therefore they're doing nothing for now. The other alternative is to bring in immigrants who are going to accept the low-paying jobs. Well, if these workers are not available, then you have to hike these wages exceptionally higher to attract and convince American workers to get out of the couch, to get out of their parents' home, to get out of the NFT crypto craze, to fill these jobs. And wage inflation has ripple impacts. One of them, or perhaps the main one, is higher end prices for you and I, the consumer. And inflation is becoming a worldwide phenomenon. It's all over the place. For example, listen to this. More UK businesses than ever before are worried about inflation, and a record number are planning to increase their own prices. So prices over at the UK are surging out of whack. Now ask yourself a question here. If you blame inflation on Joe Biden, for example, is Joe Biden the Prime Minister of the UK? Of course not. Now, if you blame inflation on the virus, for example, we had periods of lockdowns, reopening over and over and over again, a variation of the response to the virus across many countries. Yet inflation has been constant, has been rising higher and higher and higher. So that's not it. What is the reason behind inflation? Once again, inflation is always a monetary phenomenon, specifically by the Federal Reserve. So even if the Bank of England starts to jack interest rates higher, that's not going to do a damn thing. The higher prices over at the UK, and the reason is all of these commodities that the United Kingdom and other countries import and export, they're all dollarized. And therefore, until and unless the Federal Reserve, the central bank of the world, starts to act, it doesn't matter what the Bank of England is going to do. It doesn't matter what the Bank of Russia is going to do. It doesn't matter what the Bank of Mexico is going to do. Inflation is going to continue to rise out of whack. And therefore, when America sneezes, the whole world catches AIDS. And now you understand why people overseas hate this country. Take a look at the Eurozone, for example. Inflation is surging out of whack. Be it food, alcohol, tobacco, energy, non-energy, services, all surging out of whack. And the risk here is a stagflation crisis. For example, take a look at passenger car registration in Germany. They dropped down significantly, meaning that Germany is not producing cars anymore. Part of their GDP, the German GDP, is car production. If they're not producing and exporting cars, the GDP will go down. You combine that with higher prices due to the chip shortage, now we have a stagflationary action in the German economy. We're already seeing it in the Brazilian economy, for example, and many other economies across the world. You can argue that China is still in stagflation, and soon enough, Germany will face the same fate. And you don't have to travel far to find inflation. You just have to look down, south of the border, in Mexico, because inflation is extra spicy south of the border. Whether you look at the Mexican CPI, for goods, for services, the core CPI, they're all surging out of whack. And inflation in Mexico is hitting the highest level in 2 decades. Now think about this. After the disaster of NAFTA, California, for example, lost an insane amount of its agricultural output. To who? To Mexico. And last time I checked, there is no shortage of food in Mexico. Matter of fact, we import our food from Mexico. Mexico is so rich with food, agricultural products, oil. There is no shortage of commodities in Mexico. So why are they facing higher inflation? The answer is because inflation is a monetary phenomenon. It's not a supply and demand issue. Now, let's play the devil's advocate, because we have a camp that says perhaps the Fed will commit a policy mistake if they raise interest rates higher. And the reasoning behind that is inflation is already cooling down because the economy is slowing down. And this happened to be the camp that says a recession is going to happen because everything was fueled by stimmies, the stimmies are gone, and therefore economic activity will slow down and inflation will go away, and therefore be long bonds. And this camp has been wrong all along. But let's entertain this theory. Evidence number 1. Factory gauges here in this country, take for example the ISM Manufacturing Index, curled down, the lowest since January of 2021. Likewise, the gauge for prices paid and supplier deliveries all down. So if you look at this, yes, prices are going down. Inflation is cooling. The economy is cooling down. And this phenomenon is not just in the US, by the way. You look at the industrial production in Germany and France, also slowed down dramatically. Matter of fact, German power prices are down, and that could be contributing to overall factory prices down. And the reason is we have warmer weather over in Germany. That's not going to last for long if we have another storm, say in February, that's going to push these prices higher again. But regardless, the evidence is clear here. Even in Brazil, industrial production is down dramatically and has been trending down for a while. Here's the problem. We have a stagflation crisis in Brazil. So if this country is a leading indicator and the industrial production in many countries is going to slow down, just like we've seen in Brazil, then we will head into a stagflation crisis, not deflation. And here's the evidence. Perhaps the slowdown in factory prices is due to the Pokemon variant and the lockdowns and the restrictions that is following. Because when we look at the ISM Services PMI report, for example, supplier deliveries dropped off the face of the earth. A massive flush down. Why? Did demand slow down dramatically in December? Perhaps. Did commodities prices crash? Not really. So what happened here? We can attribute the drop in supplier deliveries due to the lockdowns, the restrictions due to the virus. So if anything, this dent in factory prices and factory gauges is transitory. Once the lockdowns and the restrictions are over, and let's say cases start to peak, one of two things will happen. Number one, demand will be restored again, and this will push inflation higher. Or demand will not come back, and this will risk a stagflation crisis because input costs, be it wages or commodities prices, are still moving higher. So what should you do here as an investor with this tsunami of inflation and the failure of the Fed's policy in reaching maximum employment? You combine that with the weather phenomenon, the labor shortage, the virus, etc., etc. What should you do here when the Fed says we have to be hawkish because we screwed up? We have to raise interest rates higher because inflation is not transitory. Do you take the Fed at their word and trust what they're saying, or do you fight them and say they're just bluffing? Because remember this, back in 2020, 2021, when this channel and many other channels were warning that the Fed will screw up, inflation is not transitory, this channel called inflation not transitory back in January of last year. The opposition from the bulls and market pigs said, well, don't fight the Fed. The Fed remains accommodative, and this is all what matters to the stock market. And therefore, you have to be long the stock market. Don't fight the Fed. And they were correct for the most part. So why fight the Fed now? What is the rationale behind fighting the Fed now when they are indeed changing from dovish to hawkish? What is the wisdom behind that? Or is it just endless greed, endless faith that the stock market will continue to go higher and the Fed is just bluffing? Take, for example, this article that says, "Is it time to fight the Fed?" This veteran strategist says the central bank will not risk a 20% drop in house prices and a 30% slide in stocks. Oh, really? You think the Fed works for you or for the rich? The rich who already cashed in, they're dumping their stocks, they're dumping their properties like crazy to cash in the top of the market. And look at Jerome Powell with the gloves. What a punchable face. And here's the last thought I want to leave you with. The real risk to the market is not tapering. We can live with tapering assets purchasing programs like bonds and mortgage-backed securities. Yes, the market and the real estate market in specific will take a dent, but we can live with that. Higher interest rates, on the other hand, are crushing due to the insane level of debt and the overvaluation in the stock market. But yet again, raising interest rates by 25 basis points, that's nothing. It might rattle the high valuation pockets in the stock market. It might cause a correction if it is indeed 25 basis points, and we'll take it from there. And it's not more aggressive than that. But the real risk in changing the Fed's policy is unwinding the balance sheet. Unwinding their $9 trillion balance sheet. Now, they're not going to get rid of all of it, but what if they get rid of 3 trillion, 4 trillion, 5 trillion? You're removing all of that support from corporate bonds and the stock market. You're taking trillions of dollars away. And it all depends on how the Fed will unwind its balance sheet. Will it be by dumping these bonds? If that is the case, oh boy, the nuclear scenario will happen. If it is waiting to maturity for all of these bonds and other assets in their balance sheet, then that's a better scenario for the market. So far, the Fed hasn't been clear on what unwinding the balance sheet actually means. They want to stay flexible and not define this for us to keep expectations in check. If inflation doesn't go down after tapering and raising interest rates by 25 basis points, perhaps they're going to start dumping and unwinding the balance sheet, and this will be really aggressive. On the other hand, if inflation starts to slow down and respond to interest rates rising higher, then perhaps their unwinding will be via maturity, holding till maturity, and that will be a better scenario for the market. Either way, the risk versus reward, folks, is not looking good, be it for the equities market, for the real estate market, and even for the entire economy. And with that out of the way, let's move on to cover the market's information, starting with the performance of last week. And here we go! The Dow Industrial Average on Friday closed down by 4.81 points, or a decline of almost nothing, pretty much on the flat line. What about the Nasdaq? Closing in the red, down by 144.96 points, or a decline of almost 1%. The S&P 500 also closed in the red, down by 19.2 points, or a decline of 0.41%. And here are the performances for the different sectors of the market on Friday, leading the pack at number 1, capturing the gold, metal, energy. Number 2 for the silver, materials. Number 3 for the bronze, financials. The laggards of the day led by technology, consumer cyclicals, and healthcare. Let's contrast this with the performance of the week, leading the pack once again and capturing the gold, metal, energy. Number 2 for the silver and the bronze, financials. Because at number 3, materials, pretty much on the flat line, not an impressive performance here. But look at the laggards, led by technology, down over 5.5% for the week. Healthcare, communication services, all down big. And the theme is clear. Highly inflationary, highly defensive, highly following the action in the bond market. As the 10-year yield surges, your only options are energy and financials. Perhaps some pockets in materials, but you gotta be careful with ETFs. What about the advance to decline ratios on Friday? NYSE 49% advancing versus 47% declining. The NASDAQ 39% advancing versus 56% declining. The breadth continues to be bad, specifically for the NASDAQ. Moving on to commodities, futures, what's going on here? On Friday, crude oil prices pretty much closed on the flat line, although the WTI, the notable loser here, closing down by a little over half a percentage point. Heating oil prices were up, so were natural gas prices, gaining over 3% on Friday alone. What about softs? Green across the board, with exception of sugar, the loser for the week, down a little over half a percentage point on Friday. Yet we have massive gains here, specifically for cocoa, gaining over 4% on Friday alone. Followed by coffee, the massive run in coffee continues. These futures gained over 3% on Friday alone. Then we have OJ also rebounding and gaining a little over 1% on Friday. Meanwhile, cotton and lumber pretty much on the flat line, be it a positive closing. What about metals? A little rebound here, small rebound for gold, silver, copper, palladium. But again, the losses for the week are staggering for metals, and the reason is the 10-year yield pops significantly higher. What about meats? What's going on here? Lean hogs futures down big on Friday, down over 3.5%, almost 4%. On the other hand, we have live and feeder cattle futures pretty much in the flat line. What about grains? The run in soy continues, be it soybeans, soybean meal, all closing with massive gains. On the other hand, soybean oil pretty much in the flat line. And this is the same kind of activity that we got from oats and canola, all in the flat line, while we have gains led by wheat, rough rice, and corn. And let's do some commodities news here. For fertilizers, we're seeing these prices down significantly. Matter of fact, the biggest drop since 2009. Now, does that mean that this is the end of the run in fertilizers? The answer is no. And here it is. Fertilizer prices sagged most since 2009 in break for red-hot rally. Soaring fertilizer prices that have helped drive up food inflation finally tumbled this week, but the reprieve may be short-lived. What are they talking about here? The green market's North American fertilizer price index fell 12% on Friday, a massive down day, the most since 2009. Prices for urea, a type of nitrogen fertilizer, swung widely. They rose and fell by more than $100 per short ton every day this week, as the market tried to assess prospects of spring demand and natural gas prices, which came down off the highs in Europe. Here's the problem. We're waiting the outcome of the talks between Russia and the US in January 10th. If these talks fall apart, oh boy, natural gas prices will pop higher again, and so will fertilizer prices. This week's drop is not a sign that high fertilizer prices will continue to ease, Maxwell said in an email. Major producers like Middle East and Egypt are sold out of urea throughout February, and much of Europe remains shut. So those looking for tons will have to search far afield, quote unquote. She also added, China, the best option for spare supply, remains out of the market on an export ban that runs all the way till May. They're banning the export of fertilizers because they need those supplies in China. China is hoarding food like crazy, as if China knows that we have an upcoming famine. What about lithium? Lithium prices, we talked about this just a few days ago. Lithium prices are soaring. How do you play the pop in lithium prices? You can buy EV manufacturers. The problem is we have a war. an EV war between Tesla, GM, VW, Ford, etc. At some point, this war will crush their margins because they have to compete with each other. And as legendary investor Peter Lynch said, when there is a war, buy the bullet stocks. What are the bullet stocks here? Lithium miners. I am long Ford, but at some point, even Ford is going to go down and stall. Yet the miners will continue to gain because lithium is the new oil. So investing in lithium miners is a great idea. You have to wait for the dips and add these lithium miners to your long portfolio. Lastly, before we move on, what about the weekly performance for commodities? The gains were led by heating oil, lumber, and soybean meal. Insane gains in a matter of weeks. The laggards, metals, and sugar. It wasn't a sweet week for sugar. Moving on to the big casino, the options market. What's going on here? The action on Friday got a little heated in buying puts. Notice the call to put ratios. They went down due to a lot of put options buying. What does that mean? It means that we're getting closer and closer to a short-term bottom, specifically in the Qs. Regardless, Apple remains the hottest table in the casino, closing the week on Friday with over 1.2 million contracts that traded hands on Friday alone. About 60% of those were calls. Tesla, number 2, with a little over 1.1 million contracts traded on Friday. About 53% of those were calls. Lucid Motor, number 3, with almost 700,000 contracts on Friday. 59% of those were calls. Moving on to the unusual activities that took place in the options market on Friday, starting with the ticker IFF. This is for International Flavors and Fragrances. Not a usual name that we see here, and therefore this trade is highly interesting and highly unusual. They're buying calls here, betting on an upside for IFF. They bought the 155 calls for the expiration date February 18th, with expectations that the name could pop higher by more than 9% by then. They paid about $1 a piece to enter this trade, all in all spending about $1.7 million. And what about the trade for the ticker ADI, Analog Devices? A lot of put options buying on this name. In this case, they bought the 155 puts, the expiration date February 18th, with expectations that the name could go down by more than 8% by then. And they paid about $2.50 a piece to enter this trade, all in all spending about $2.5 million. What about the ticker BYND, Beyond Meat? They're betting on a short squeeze here. The news from KFC excited some short covering. We'll see how sustainable this phenomenon is, but they're betting for more upside for Beyond Meat. In this case, they're buying the 75 calls for the expiration date, January 14th, meaning this upcoming Friday, with the expectations that the name could pop higher by more than 9.5% by then. They paid about $1.15 a piece to enter this trade, all in all spending about $750,000. What about the trade for the ticker ARKKKKK for Tesla witch Cathie Wood? The shorts are piling in here, and this is highly interesting because they're betting on massive downside. They're buying the 64.22 puts for the expiration date February 18th, with the expectations that RKKKK could blow up and collapse by more than 24% by then. They paid about 75 cents a piece to enter this trade, all in all spending about $400,000. What about the ticker ROKU, Roku? I believe this was a component of RKK, but Cathie Wood dumped some of Roku. Not sure. In any case, somebody's bidding for a downside here for the name by buying the 170 puts for the expiration date, January 14th, with expectations that the name could go down by more than 6% by then. They paid about $4 a piece to enter this trade, all in all spending about $2 million. And notice this trade for the ticker TQQQ. You combine this trade with the last trade at the bottom of the table with the KRE, and perhaps that offers a clue of what's going to happen next week. Hold that thought, because they're buying the 160 calls for the TQQQs, the expiration date this upcoming Friday, with expectations that the name could pop higher by more than 11% by then. They paid about 55 cents a piece to enter this trade, all in all spending about $300,000. Now the TQQQ is the triple leverage ETF for the Nasdaq, meaning they're betting that the Nasdaq will rebound significantly higher. What does that mean? Are we about to see a short-term top in the 10-year yield? If that is the case, then indeed the Nasdaq will rebound higher, but specifically the high multiple names, the oversold names, that will offer a great opportunity for us traders to buy call options in these names and play the ride or the pop higher. Anyhow, what about the ticker UAL for United Airlines? They're buying puts here, the 44 puts, for the expiration date February 11th, with expectations that the name could drop down by more than 7% by then. They paid about $1.40 apiece to enter this trade, all in all spending about $700,000. And here it is at the bottom of the table. What about the KRE, the ETF for regional banks that tracks the 10-year yield? They're buying puts here, the $70 puts for the expiration date February 18th, with expectations that the KRE will drop down by more than 9.5% by then, which means that the 10-year yield will also top and start to trade down. Now, they paid about 90 cents apiece to enter this trade, all in all spending about $500,000. Moving on to the heat map analysis. Once again, this is the daily chart or the daily heat map, for Friday's activity. Every time we have a pop in the 10-year yield, value outperforms growth. And this is exactly what you're seeing. The tame underperformance from the big caps. But look at chips, software, the high multiple names, Tesla, Zoom, Roku, all of these names are getting clobbered. On the other hand, the value names, the inflationary stocks, the lacks of financials, energy, certain pockets of materials, industrials, consumer defensives, and oh, by the way, the value names in healthcare, the big pharma names, all outperforming on Friday. Now, when we switch to the weekly heat map, the picture gets clearer. Massive underperformance for technology, software, and the high multiple pockets in the stock market. And the contrast couldn't be any clearer. For example, a value name happens to be Intel, Micron, VMware, Dell, IBM. All of these are value names within technology. They closed the week in the green, believe it or not. On the other hand, high multiple names like AMD, CrowdStrike, Palantir, Shopify, Nvidia down big. Unbelievable. The contrast is also clear within healthcare. The biotech names, the high multiple names down big. The value names, J&J, Merck, AbbVie, closed the week in the green. AbbVie did not close in the green, but almost in the flat line. The same phenomena can be found within communication services. High multiple names like Netflix, Twilio, Dash, Snapchat, all down big. But the old school value names like Disney, Verizon, AT&T, all outperforming. When we look at auto manufacturers, NIO, Li Auto, Xpeng, Tesla, the high multiple names down, the value names, Toyota, GM, Ford, Honda, all trading higher. Bucking the trend, of course, is Lucid Motor, but Lucid has different attributes to it. It's a SPAC, it moves via options activities, so this is the exception of the rule. Yet when interest rates move higher, financials outperform dramatically. Oil, certain pockets of technology and materials, you have to be picky here, and consumer defensives. Now be wary of the performance of certain reopening stocks, specifically airlines and cruises, but mainly cruises. We continue to get bad news here for cruises. The infamous Princess Cruise is now docked with at least 12 cases. We're also seeing a lot of cancellations from Royal Caribbean, for example, canceling a lot of cruises, and the reason is consumers are canceling. It's not the severity of the disease. It's the fact that if you get it, you're not going to be able to get out of the cruise. Not to mention many other restrictions of quarantining and taking tests, yada, yada, yada. Why the headache? But the virus is the least of the problems that cruises are facing. Major cruise airlines like Royal Caribbean are canceling sailings amid the thing crisis, and it is a signal that the industry troubles are far from over. This is not the main problem. Look at the balance sheets. As interest rates move higher, these companies are not going to hold. And lastly, here is the weekly chart for the ETF heat map, and as you can see, the outperformance is from Energy, XOP, XLE, decent gains for the week. Likewise, financials, KRE, XLF, KBE, all outperforming. When you look at materials, you got to be picky here because gold is not performing. Copper, wishy-washy here, but you got to pick the XME over the XLB because the XLB is heavy in gold and silver. XME concentrates on copper, steel, aluminum, building, fertilizer stocks, and therefore you want to choose the XME over the XLB. And the underperformance could not be any clearer here. Tech down, chips down, the SOXL, the XLK all down, healthcare, the XLV is down, but look at the XBI, biotech, the high multiples down even more. And the contrast could not be any clearer here between value and growth. Value, no massive gains here for the IWD or VTV, yet they closed in the green for the week. On the other hand, growth, IWF, VUG, IVW, all closing with massive losses for the week. So again, use the 10-year yield as a guide for you. When that moves higher, you want to be in value. When it pulls back, you want to be in growth. This is the trading strategy, of course. The investing strategy, you got to have an outlook. Is the 10-year is going to move higher in the long run, or is it going to collapse? If you believe, like me, that the 10-year will continue to move higher because the Fed will indeed raise interest rates, then you got to stick to value. When the 10-year dips, you buy the dip in value. When the 10-year bottoms, you buy puts on growth. Moving on to the charts analysis, let's start with a 30-minute chart for the SPY. What's going on here? It is still hugging 466 as support in a bearish formation. We are not oversold yet here in the SPY's chart, so that could open the door for more downside and perhaps revisiting 461 as support. And here's the daily chart with the continuous contract for the S&P 500. We are still above the bull to bear advantage line, which happens to be 4,657 by a hair. It is just a matter of time before we violate that line and the bears will confirm the advantage. It is already confirmed, by the way, because the selling is happening on higher than average volume and the momentum indicators are already in negative divergence. If 4,657 is violated, we're going to look down for 4,549.5 as the next support. Moving on to the Q's 30-minute chart, what's going on here? It moved to the downside. The bigger picture was the bear flag formation, which produced another leg down to retag the support of 379. Did we see a meaningful rebound from 379? The answer is not really. Now, is this bullish or bearish? The answer is it is bearish, because the chart should have been able to rebound higher from 379. The assumption was that this is a solid support line. It has yet to be violated, so we should be open to the outcome that the Nasdaq could rebound higher this upcoming week from 379. It could happen. It's a long shot, but it could happen. And it will happen if the 10-year yield cools down. Here's a daily chart for the continuous contract for the Nasdaq. We went down to retag 15,500 as support. Matter of fact, the low of the day was almost to the penny. The bears are already in charge in this chart. We have the confirmation from the negative divergences on both the RSI and the MACD indicators. We also have selling on higher than average volume, although the good sign for the bulls here, look at the volume of Friday versus Thursday. It went a little down. It ticked a little down. So did we reach the peak of the selling here? Could be, but you gotta watch the 10-year yield. If the 10-year yield is topping and starts to pull down, you're gonna buy call options on the high multiple names, the RKK kind of names, the NVIDIA kind of names, because they're gonna pop higher. You don't want to miss these kind of trades. If we have more downside to come, then we're going down to 15,000 for support. And here is the weekly chart for the Nasdaq. This is concerning, folks, because we had what it appears to be a false breakout from the channel. The channel goes back all the way to 2020. Usually, not always, in a charting behavior, when you have false breakouts in what it appears to be a long-term formation or a trend, it is a signal that the break will happen in the opposite direction. If that happens, the break will happen to the downside from this channel. What does that mean? Are we at a top in the Nasdaq? Here's a monthly chart, and this is really scary. Look at where the MACD is trading to the moon, but it is curling down and it's about to cross to negative territory. We also have negative divergence on the RSI. Now, the MACD is a lagging indicator. You use the MACD to confirm the move, but this is not looking good. Your leading indicators are the RSI, is already in negative divergence. The other leading indicator is the candlestick pattern. We had a reversal candle. You can call it a shooting star. You can call it a shooting triangle. Doesn't matter to me. It's a reversal candle. And then we had an indecision candle for the month of December. Now we have what it appears to be a confirmation candle to the downside, that the candle in November was the top. This is really terrifying here, specifically for the Nasdaq and tech bulls. And if you thought this was bad, look at the IWM, the 30-minute chart. We had a bear flag played to the downside, violating the support of 218. The good news is we have what it appears to be a triple low. It's not a triple bottom yet, but if it holds, this will be a good signal for the IWM to pop higher and reclaim 218 as support. If it doesn't, then we have a gap below it, 213 to close. If that doesn't work, then we have 211 as the next support. And here is a weekly chart for the Russell 2000, the big one. We are now trading below the bull to bear advantage line, which happens to be 2,264. We have yet to violate the line in the sand, which happens to be 2,100, but we're getting closer. This is a bear flag formation from a weekly perspective, and the monthly is even more terrifying. We have a negative divergence on the RSI, and we have a negative crossing in the MACD indicator. The month is still young, but boy, doesn't look good here. What about the Dixie, a daily chart for the dollar index? We have a confirmation that the Dixie is losing support of 96. This will be good for commodities to move higher. The problem is, it is not being reflected in gold prices. We've been waiting and waiting and waiting for the old man to rise from the dead. But so long as the 10-year yield continues to pop higher, gold is not going to find any relief from the dollar losing 96 as support until and unless the inverse relationship between gold and the 10-year reverses. And this will only happen when market participants realize that there is no other safe haven here. Stocks are overvalued. They're going to get crushed. Cryptos are risk-on kind of asset. It's not an inflation hedge. That's going to get crushed too. Where do you go now? You have commodities, oil, and you also have gold. If market participants start to think that way, then, and only then, gold will rise from the dead. For now, it doesn't look good for gold. We have negative divergence in the RSI. We have a crossing in the MACD to negative territory, creating red impressions in the histogram, the daily chart. In all likelihood, we're going to retag 1,763 for support and take it from there. If it holds, then this will be a good signal for gold. And here's the chart for the 10-year yield, perhaps the most important chart in the stock market right now. It is a bond chart, but it happens to be the most important chart in the stock market because it is the main driver for now. We stopped at around 1.8%. Did you know? Did anybody expect that we'll be at 1.8% just 7 days after the start of the new year? Not even me. But we stopped at a resistance, closed below that resistance, 1.77%. Look at the RSI, look at the MACD. If the 10-year starts to top, then the trade will be buy call options on the high growth names. And perhaps you want to buy put options on the names that ran high as the 10-year moved higher. And these names happen to be the financials. And here's a weekly chart for the TLT bond prices. What's going on here? We have a confirmation closing below 149. Not a good sign for the TLT. It could rebound higher, but this will be a dead cat bounce. So again, you can trade it, but you cannot invest based on any bounce in the bond market. The trajectory for now is yields higher, bond prices down. What about the VIX from a 4 hours perspective? We are in what it appears to be a bull flag consolidation. Waiting and waiting and waiting to pop higher above 20. If that fails, then the SPY will bottom. Look at the MACD indicator from a 4 hours perspective. It is curling down. It is not showing red impressions yet. That would be the confirmation that the VIX is not going to pass 20 and the SPY will bottom. We're not there yet, but it is curling down. So you got to watch this one continuously. On the other hand, what about the 4 hours chart for the VXN, the VIX for the NASDAQ? A better bull flag here, a better MACD reading, it is still trading positive and it's not curling down. So you gotta watch these two, the VIX, the VXN in combination with the 10-year yield. What about Apple, a daily chart? What's going on here? It pulled down. It is struggling to catch the support of 172.4. This is my number. You could round it down to 172. It doesn't matter to me. But if that fails, then Apple will go down and close the gap at 165.32. The selling is happening on higher than average volume. We have negative divergences from both the MACD and the RSI indicators from a daily chart perspective. The bears are in the driver's seat in this chart. And as Apple goes, so will the market. And here's a 30 minutes chart for Tesla, the souffle. What's going on here? We had the bear flag that played to the downside despite the gap higher in the morning in Tesla. Now we're waiting for 995 as support. It doesn't mean that we have to go all the way down there. If the NASDAQ rebounds higher overnight because the 10-year yield is down, then Tesla will also trade higher, but the resistance will be once again 1,090.5. Let's say we have another down day tomorrow and 995 doesn't hold, then we have a gap below to look forward to. Tulips, BTC, what's going on here? An ugly weekend, shall we say, violating 42,000 and the bottom was around 41,000 for now. We're getting closer to oversold readings, but we're not out of the woods yet. You need to see 42,000 reconfirmed as support. You need to see dramatic improvement in the momentum indicators. You need to see buying on higher than average volume before we have a confirmation the BTC indeed bottomed. And a lot of you brought up the monthly charts. They don't look good at all. We have a head and shoulder formation and the MACD is about to cross to negative territory. What does that mean? Any pop in BTC should be met with the sell the rip mentality, at least for now. Lastly, what about AMC? 30 minutes chart. What's going on here? We had the bull flag popping above the sloping line of resistance. The problem is, it was a gap and crap right away. And I told you this will happen if the 10-year yield pops higher. And this is exactly what happened on Friday. And therefore, the pop in GameStop, AMC did not live for too long. Yes, both names closed in the green on Friday. The problem is well below the highs. And what we see right now in AMC's chart is a bear flag pattern. The chart already closed the week below 26. This is a confirmation that this ape mania in AMC is coming to an end, and it's an ugly end. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar this week? Nothing major on Monday, but on Tuesday we have the Small Business Index. And Wednesday, the most important day for the week, the CPI, the Consumer Price Index. We also have the Beige Book. So Wednesday will be extremely important. If the CPI comes out a little cooler than expectations or down month over month, don't be surprised to see the 10-year topping. That will come hand in hand with a rebound in the Nasdaq. Thursday, January 13th, we have, per usual, the weekly jobless claims and the very important Producer Price Index. Lastly, Friday the 14th, we have retail sales, the import price index, industrial production, the University of Michigan Consumer Sentiment Index, and business inventories. A lot of macro data coming out this week. So buckle up your seatbelts. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.